would have increased, the profit of the company would have increased. And therefore, what we need to do once we make that assumption, we proceed and we compute two items. One, we compute something called the increase in earnings. Increase in earnings basically refers to the increase in the profit. So if the convertible debentures were converted into ordinary shares, the profit for the current year would have increased with how much? We're going to look on how we compute this at the different types of potential ordinary shares, because we have different types of this. But generally, when computing the increase in earnings at the debentures, this one, we take into account the interest which was paid. How much interest was paid to the holders of these debentures? And then we multiply that interest paid with 1 minus tax rate. We multiply that interest paid with 1 minus tax rate. So why do we do this? Why do we multiply that interest paid with 1 minus tax rate? It's because we know that in tax, interest on debentures is allowable expense. In other terms, in computing the profit for the year, usually we deduct the interest. In arriving at the profit of the year, we will have deducted what? The interest. So that's why we say that if these debentures were converted into ordinary shares, the profit of the company would have increased with the interest which was paid, but net of tax. We multiply that with 1 minus tax rate. Number two, we compute something called the increase in number of shares. Increase in number of shares. Increase in number of shares is very simple. This refers to the number of ordinary shares which would have been issued by our company, assuming these debentures were converted into ordinary shares. So if the debentures were converted into ordinary shares, how many ordinary shares would have been issued? And actually, in computing this, we use the conversion rate. The conversion rate. The rate at which these debentures are supposed to be converted into ordinary shares, something which the examiner will always give you, the conversion rate. So after now computing these two items, the increase in earnings, increase in number of shares, you then proceed and compute the diluted earnings per share. This is the formula for computing the diluted earnings per share. You take the PATOS, which is used in the computation of basic earnings per share, one also used in the computation of basic earnings per share, and then to the PATOS we add increase in earnings, which we will have computed here. To the one also we add increase in number of shares, which basically we will have computed there. That's basically how we compute the diluted earnings per share. But now I want us to look on how we compute these two items: increase in earnings, increase in number of shares, in relation to different types of potential ordinary shares. So maybe first of all here we can highlight, or basically we can look on the types of potential ordinary shares, types of potential ordinary shares. So we have different types of this. One, we have the convertible debentures, convertible loan stocks, and also the convertible bonds. So all these are treated in the same way in the computation of diluted earnings per share. Number two, we also have the convertible preference shares. Number three, we have the stock or share options. And number four, we have the contingently issuable shares. Contingently issuable shares. I'll be able to explain what you mean by all that. So I want us to start with the convertible debentures, the convertible bonds, or basically the convertible loan stock, stocks. And in this case, remember I've said we need to discuss on two, or basically how we compute two items in relation to each of these. Here, how do we compute the increase in earnings? How do we compute the increase in number of ordinary shares? Because in this case, I've said, if, for example, you're told a company had issued convertible debentures, convertible roll stock, convertible bonds, for you to be able to compute the diluted earnings per share, you need to compute two items: increase in earnings, increase in number of shares. But in that case, we have said, for you to be able to do that, we have said, we make an assumption. We make an assumption that these convertible securities were converted into ordinary shares during the current year. So as a result of that, we compute two items. One, we compute the increase in earnings. And the increase in earnings here is equal to the interest which was paid by the company. How much interest was paid to the holders of these convertible securities? We multiply that with 1 minus tax rate. So if the tax rate is 30%, then this one will be 1 minus 0.3, which will be 0.7. So that will be the interest net of tax, the interest paid net of tax. Number two, how do we compute the increase in number of shares? Increase in number of shares, remember you have said that this refers to those ordinary shares which would have been issued by the company, assuming these convertible securities were converted into ordinary shares. How many ordinary shares would have been issued? Now, for us to compute this one, we use the conversion rate. We use the conversion rate provided. The conversion rate provided. So the conversion rate generally is the rate at which these convertible securities can be converted into ordinary shares. Always that is something which the examiner will have given you in any question whereby you're required to compute the diluted earnings per share. That is basically what you need to know as far as the convertible securities are concerned. How do we compute those two items? Increase in earnings, increase in number of what? Of shares. Now, before we look on these other potential ordinary share, there is something you need to note from what we did in the topic of financial instrument, IFRS 9, and basically what we are discussing here, the topic of EPS, IS 33. If you can be able to recall at the IFRS 9, we see that if a company has issued any of these convertible debt instruments, we refer to this as compound financial instrument. If you can be able to recall what we did in that topic of financial instrument, we refer to these convertible securities as compound financial instrument. We looked on how they should be accounted for under IFRS 9. We said the company should split the two components, equity component, the liability component. But now under this topic, or under IS 33, if a company has issued convertible security, we are referring to that as what? A potential ordinary share. So it is important for you to note that, because majority of the students tend to confuse that under the two standards. So let's look on this convertible preference shares, convertible preference shares. So these are preference shares which can be converted into ordinary shares. In this case, we just need to ask ourselves, how do we compute these two items? How do we compute the increase in earnings? So the increase in earnings basically refers to the amount by which the profit attributable to the ordinary shareholders would have increased with, on the assumption that these convertible preference shares were converted into ordinary shares during the current year. The increase in earnings here is always equal to the preference dividend for the year. The preference dividend for the year. The preference dividend for the year. So, and in this case, you can see these dividends, are we multiplying them with 1 minus tax rate? No, because dividends are not tax allowable. Dividends are not tax allowable. So that's why we are not multiplying them with 1 minus tax rate. Then number two, how do we compute the increase in number of shares? Increase in number of shares. Equally, in this case, we use the conversion rate provided. Use the conversion rate which is provided. You'll be given the conversion rate, and basically what you need to determine here R, the number of ordinary shares which would have been issued, assuming the convertible preference shares were converted into ordinary shares. The other potential ordinary share, that is number 3, is the stock or the share option. The stock or the share option. So what do you mean by the stock or the share option? This is something we discussed yesterday when we were looking on how we compute the basic earnings per share. And we said that this is a privilege, or in other terms, is a right which is given to the employees of the company to buy the shares of the company in the future at a price below the market price. If you're given a privilege, if you're given a right by the company to buy the shares at a price below the market price, that is a share or a stock option. Basically, we say this is a good example of an employee's benefit. It's a benefit which can be given to you by the company, mostly whenever the company wants to do what? To encourage you to work with that company for a long period of time. You will secure a job with a certain company, and you agree with that company that if you work with that company for the next 2 or 3 years, you'll be given a privilege to buy the company shares, to buy a certain number of company shares at a price below the market price. Is basically a form of employees' what? Benefit. So in this case here, what we need to do, we need to compute these 2 items: increase in earnings. Increase in what? In earnings. Remember, in this case, we have said the increase in earnings. This is the amount. Or this refers to the increase in PATOS. This refers to the increase in the profit attributable to the ordinary shareholders, assuming these share or stock options were exercised during the current year. Year. And in this case, the increase in earnings, or basically the increase in profit, this one is always equal to 0. Why? The reason why we say it is equal to 0 is because if, for example, you are an employee of a company, you are given a privilege, you have already entered into a contract with that company, whereby you're given a right to buy the shares in the future, to buy the shares of the company in the future. Until such time when you buy the shares, you are not entitled to any form of return from the company. It's not like whereby you are issued with convertible debentures. If you're issued with a convertible debentures, which is a potential ordinary share, just like a stock option, you are entitled to a return. You are entitled to interest. And that's why we are saying here, now, if you convert these debentures into ordinary shares, will there be some savings by the company? Yes, there will be some savings by the company, because that interest which the company was paying you, that interest will not be paid during the current year because you converted your debentures into ordinary shares. But we are saying these are privilege which is given to you to buy the shares in the future. Until you buy the shares, you're not entitled to any form of return from the company or in relation to those shares. So even if you bought the shares during the current year, we say that there will be no any savings by the company because there is nothing the company was paying you. So therefore, the increase in earnings is always equal to 0. Then, what about the increase in number of shares? The increase in number of shares. The increase in number of shares, this one is equal to the bonus element. This one is equal to the bonus element. For you to be able to recall this, or basically for you to be able to understand this, remember what we discussed yesterday at the basic earnings per share. We said, if, for example, the employees of the company were granted a share or a stock option, and they exercise that share or stock option, it basically means that they will buy the shares of the company at a price below the market price. And we said anytime the shares of the company are issued at a price below the market price, in this case, we assume that some of the shares have been issued free of charge, others have been issued at full market price. So therefore, here in this case, what we do, we assume that, or for us to be able to compute this, we assume that the employees exercise this stock option. Exercising means that the employees bought the company shares. year, which ended 31st of December 2023, was shillings 20. And then we are given some additional information about your tool. On 1st of April 2023, the company invited the current shareholders to subscribe for 𝐼𝐍𝐶 on the basis of 2 new shares for every 3 shares held at concessionary price of shillings 15 per share, when the market value on 𝐾𝐽 basis was shillings 20 per share. Number 2, we are told on 1st of July 2023, 𝐶𝐕 Limited issued 36 million ordinary shares at a full market price. Number 3, we are told on 1st September 2023, the company made 1-for-3 bonus issue of ordinary shares using the share premium account. Number 4, on 1st of October 2023, holders of shillings 80 million 12% convertible preference shares exercise their conversion right. So what are we required to do from this information? 1, we are required to calculate the basic earnings per share for the year which ended 31st of December 2023, 6 months. Number 2, we are required to calculate, here we have 9 months. So we are told shillings 80, or holders of shillings 80 Okay, so let's go through that particular question. We see what we are told, and equally what the examiner was requiring. So the question is, on 1st January 2023, 𝐶𝐕 Limited had in issue 43.2 million ordinary shares of shillings 10 par value, and 12 million 12% convertible redeemable preference shares of shillings 10 par value each. The preference shares are convertible into ordinary shares on the basis of 80 ordinary shares for each shilling 100 of the preference shares for each of the preference share capital. 𝐶𝐕 Limited profit after tax from the continuing operation for the year ended 31st of December 2023 amounted to 201,600,000, and for the year which ended 31st of December 2022 was 97.2. And then you're told the average market price per ordinary share during the year, which ended 31st of December 2023, was shillings 20. And then we are given some additional information about your tool. On 1st of April 2023, the company invited the current shareholders to subscribe for 𝐼𝐍𝐶 on the basis of 2 new shares for every 3 shares held at concessionary price of shillings 15 per share, when the market value on 𝐾𝐽 basis was shillings 20 per share. Number 2, we are told on 1st of July 2023, 𝐶𝐕 Limited issued 36 million ordinary shares at a full market price. Number 3, we are told on 1st September 2023, the company made 1-for-3 bonus issue of ordinary shares using the share premium account. Number 4, on 1st of October 2023, holders of shillings 80 million 12% convertible preference shares exercise their conversion right. So what are we required to do from this information? 1, we are required to calculate the basic earnings per share for the year which ended 31st of December 2023, 6 months. Number 2, we are required to calculate the restated earnings per share for the year which ended 31st of December 2022. And number 3, we are required to calculate the diluted earnings per share (DEPS) for the year which ended 31st of December 2023. Automatically, we're going to start with Roman 1 of that particular question. And in Roman 1, we are required to compute the BEPS, basic earnings per share, for the year which ended 31st of December 2023. The basic earnings per share for the year which ended 31st of December 2023